You hear about JP Morgan covered 700 plus contracts at the very, very bottom.
Right.
That's coincidental, huh? Or you hear on how, let me just give you the exact number here on SLV. Who's the primary custodian of SLVs, right?
JP Morgan.
JP Morgan. Right before we went out of town, we had our member golf tournament, which started the day that the market collapsed, and which made for a very interesting first round of golf, trying to focus, getting phone calls, panic ensuing. Look, these things happen, and I think the emotion that surrounds this kind of stuff is hard for a lot of people to deal with. You have to take a deep breath and look what's underneath it. And I think after we talk tonight, hopefully people feel better, because as far as I'm concerned, nothing has changed. In fact, the fundamentals grow stronger by these types of desperate acts that we've seen, by massive margin increases.
Well, let's break it down, because the whole week people have been saying, what does Andy Schectman have to say about this? What's really happening? Because we did have that big sell-off January 30th. We had gold tank 10% in one day, silver drop over 25% in one day. They have recovered somewhat, but everybody wants to know, what does Andy Schectman think actually happened that day? Because, people are floating conspiracy theories, coordinated action, intentional margin raising. Some are saying, well, no, we always expected a pullback. That's what happens when you had such a phenomenal run up in a market. It can't just go straight up.
Right.
So Andy Schectman, what happened?
Look, there's a fine line between conspiracy and reality, what happened to me was contrived all the way. I know that there'll be some people that would disagree with that. But this was contrived. This was contrived in the respect that the margin hikes on COMEX were risen to the highest levels ever, as far as I can tell. I mean, on Christmas Day, we needed about $21,000 to hedge a 5,000 ounce silver contract, and by last week, it was $54,000 or $55,000. And for companies that have large inventories, or for traders that have large margin positions, where you take out margin and you have it in your, or deposit money into a margin account that gives you access to very large, in other words, $51,000, $52,000 gives you the ability to control 5,000 ounces of silver. Now, it used to be 21,000 just a few weeks ago, and even maybe a week or two before Christmas, it was 17 or 18,000. They have continually raised margins to the point where they've squeezed everyone, and you have what has turned into a series of margin calls. And I think that to me, it's not a bearish signal, as a lot of people think. Yes, there is a bearish result, but what it is to me is the exchange telling you that this move is real and it's getting violent, and that to me is first and foremost. I think, have gold and silver that moved up vertically and brought in a lot of leverage and a lot of players that were trying to trade on margin, and I think that the CME group got very nervous. Now, yes, there is the conspiracy theory that maybe there were some banks off sides that they were trying to let them clear their margin book. Maybe it happened, maybe it didn't, but let me just simply say this, that margin hikes don't stop physical demand. They stop paper leverage more than anything. And I think their intention was to force all the weak hands out of the market. And what it does is it reduces the ability to run giant positions on thin collateral, where, we can just post this money in our margin account and take advantage of this generational bull market. And what you get by margins going higher and higher and higher and higher, and in such a fashion that margin must be posted or those positions are closed out, you get a paper flush. And that paper flush can drop all of these leveraged traders or force them to liquidate. But that's not the end of the bull market. Even though that's what happened, that's called a shakeout, or shaking the bushes. And when you chase leverage out of gold and silver, you don't make things weaker, you arguably make them scarcer and stronger, because they're held by strong hands who aren't using leverage to stand for delivery. That's the big deal here, as far as I'm concerned, is that margin hikes don't end bull markets and metals. They usually mark the point where the next big leg higher becomes inevitable, because the metal is transferred to very, very strong hands. And in this case, again, who is standing for delivery over and over and over again? And we'll talk about the March delivery, I hope, which is pointing
big delivery month. Big delivery month.
So, Andy, because a lot of people were saying, yes, granted, you need to raise margins. It's what an exchange will do in order to keep your position. It's a form of collateral, and when an exchange raises margin requirements, it's basically saying you need to put up more cash or get out. And this market was moving very quickly, very sporadically. So there was, you could see how the CME would say, okay, this is getting dangerous. You want to keep your positions, put in more margin, which effectively forced people to either sell or increase the margin. And having that liquidity is not something everybody has. But there was some kind of consideration that the margin hikes were excessive.
Right. Well,
and that may have been some form of coordination, that they were raising them in an excessively fast and higher level than would you'd ordinarily see.
yeah, well, there are two ways that, first of all, what changed is they used to have a flat rate on the margin account, and now it's a percentage of the contract. So the higher the price goes, the math works in and of itself. It will just flow higher. But there's a second way that they do it, and that is if the CME group fears excessive volatility and leverage, that they can come in and put safeguards in. So that, to your point, is what I think people are talking about. Look, it's the same thing when the Hunt brothers tried to corner the market. The CME did what the CME does. They saved their own, and they made it so that long contracts were more or less, you couldn't do it. It was sell only. They forced the price down to protect the market. These banks will do what they can to protect themselves. They are the owners of the CME group in essence, and they're protecting themselves. But if we go back to what the Commitment of Traders report said at the end of the year and what the Economic Times said, the U.S. banks have gone that long. Now, that doesn't mean that they're long entirely. That means they have more long than short. And maybe it's getting to the point where there is enough concern that they had to flush out all of this excess liquidity, let the price get clobbered so that these big banks that are off sides could indeed cover their short positions. And it looks like short covering. I mean, here we are in the last 2 days, it's up 35%. So to see a silver market fall by 50% and then move back up 35%, remember, if it falls by 50, it has to move up 100 to get to where it was. So we're only about a third of the way recovered, but that's in 2 days. And so what it looks like to me is flushing out the weak hands, covering of short positions, and repositioning into very, very, very strong hands. It's interesting too, you hear about JP Morgan covered 700 plus contracts at the very, very bottom.
Right.
That's coincidental, huh? Or you hear on how, let me just give you the exact number here on SLV. Who's the primary custodian of SLVs, right?
JP Morgan.
JP Morgan, right? So on the day after the largest flush that I've ever seen in my career, which is 36 years long, JP Morgan added, or whoever the custodian is, will be JP Morgan, added 36.3 million shares of new shares into SLV. And each share is about 0.905 ounces per share. So that's 33 million ounces of silver were added in 1 day after the price got clobbered. And the only way shares are added into SLV is when one of the authorized participants deposits metal into the account first. So let's just think about that for a second. They knock the crap out of it. And then they issue 33 million new, or 36 million shares, which is 33 million ounces, where it's held in vaults that are controlled by the big bank, because they can do share redemptions, which they do that all the time, which is much more opaque than taking it right off of COMEX.
Let's address this head on, because I know what everyone is thinking. You hear that JP Morgan covered 700 plus contracts right at the very bottom of the smash, and you say, coincidence. You hear that SLV added tens of millions of ounces the day after the largest one-day collapse in silver in decades, and you say, normal market activity. At some point you have to ask yourself, how many coincidences does it take before you start connecting dots? Now, I want to be very careful here. There is a fine line between conspiracy and reality. I'm not interested in wild theories. I'm interested in mechanics. I'm interested in numbers. And I'm interested in what actually happened. The January 30th collapse, gold down 10% in a single day, silver down over 25% intraday at one point, that was not normal volatility. That was engineered pressure through margin mechanics. I don't care what anyone says, that was contrived. Let's walk through it calmly. Right around Christmas, it cost roughly $21,000 to hedge a 5,000-ounce silver contract. A few weeks later, it was $54,000 to $55,000. That is not incremental. That is suffocating. That is squeezing. And remember, margins used to be a flat rate. Now they're a percentage of contract value. So as silver rises, margin requirements automatically rise. Then, when volatility increases, the CME can add another layer, a volatility component, to protect the clearinghouse. That means you're getting squeezed from two directions: rising contract value, rising margin percentage. And if you're a trader who built a position at $18,000 margin and suddenly you need $55,000 per contract, you either post more capital immediately or you get liquidated. That's not optional. So what happened? A series of margin calls, forced liquidation, paper selling cascaded, stops triggered, algorithms amplified the move, and price fell like a rock. Now, people say, well, that's normal. That's how exchanges manage risk. Yes, that's partially true. But the speed and magnitude of the margin hikes were extraordinary. This wasn't a gentle tap on the brakes. This was slamming the pedal. Why? Some say it was purely risk management. Others suggest certain banks were offside and needed relief. I don't pretend to know every motive, but I do know this. Margin hikes don't kill physical demand. They kill leverage. They flush weak hands. And here's where it gets interesting. During the largest one-day smash I've seen in my 36-year career, JP Morgan, yes, JP Morgan, covered over 700 contracts right at the bottom. That's 3.5 million ounces. At the lows. Now, maybe that's coincidence. Maybe it's just brilliant trading. But then the very next day, SLV issues 36.3 million new shares, each share representing roughly 0.905 ounces of silver. That's about 33 million ounces added in one day. And who is the primary custodian of SLV? JP Morgan. Now let's slow this down. The only way new shares are created in SLV is if an authorized participant delivers physical metal first. Shares don't magically appear. Metal has to be deposited into the trust before new shares are issued. So silver gets smashed. Forced sellers dump paper. Panic everywhere. And immediately afterward, tens of millions of ounces of physical silver are deposited into an ETF vault structure controlled by the largest bank in the ecosystem. That's not retail panic buying. That's institutional metal transfer. That's balance sheet strength absorbing forced liquidation. You see, when margin hikes flush leverage, they don't weaken the bull market structurally. They change the ownership profile. They move metal from speculative traders using borrowed money into institutions using cash. And that's bullish. History supports this. In 1979 to 1980, margin hikes did not end the silver bull. They intensified it. In 2010 to 2011, violent corrections preceded vertical advances. Margin hikes are not death signals. They are transition signals. They are the exchange saying, if you want to play here, bring real capital. Now, I want you to think about the psychology for a moment. I was at our member golf tournament when this happened. Phones ringing off the hook. Panic. Fear. It's hard to focus on your swing when silver just dropped 25%. Fear is powerful. It overrides logic. People assume something fundamentally broke. But what changed fundamentally that day? Did solar panel demand collapse? No. Did EV production stop? No. Did 6 straight years of global silver deficits disappear? No. Did the US government remove silver from the critical minerals list? No. Nothing changed. Except ownership. Weak leveraged traders were forced out. Strong institutional hands stepped in. Now, let's talk about the optics. The CME says margins must rise because volatility is excessive. That's legitimate. Exchanges protect themselves. The Hunt brothers tried to corner silver in 1980, and the CME responded by changing the rules to protect the clearinghouse. Exchanges will always defend their own survival, but what's different now is that the banks are reportedly net long according to commitment of traders data. Being net long doesn't mean you have zero shorts. It means your longs exceed your shorts. So if you're net long, but still have significant short exposure, and price starts ripping higher, a flush allows you to cover at lower levels. And that's exactly what it looks like happened. Price collapses. Shorts cover at the lows. Physical flows into ETF vaults. Metal migrates into strong hands. Then what happens? silver rebounds 35% in 2 days. Now people say, well, it dropped 50%. Remember math. If something falls 50%, it has to rise 100% to get back to even. A 35% rebound is powerful, but it's not even halfway to recovery from a 50% drop. Yet the speed of that rebound tells you something. That's not a dead market. That's short covering. That's repositioning. That's consolidation. Now, layer this on top of the March delivery setup. Over 400 million ounces of paper, open interest against just over 100 million ounces registered. And ask yourself, why would someone flush the market violently right before a potentially large delivery month? To scare people away from standing for delivery. To reduce open interest. To relieve pressure. Does that mean the exchange defaults? No. It means the exchange buys time. But here's the problem. Physical demand doesn't vanish because of fear. And as long as institutions keep standing for delivery, month after month, and as long as ETFs absorb tens of millions of ounces during smashes, the structural story remains intact. What we witnessed wasn't the end of a bull market. It was a transfer event. Metal moved from weak hands to strong hands. And in bull markets, that's when the next leg higher becomes more likely, not less. Because once that transition completes, margin hikes won't matter nearly as much as who actually holds the bars.